Good day, everyone. Welcome back to accounting theory class, and I wish you all in good health and spirit. And today we would like to talk about presentation and disclosure of business information, especially accounting information. Talking about presentation and disclosure, at least we have to discuss some important issues. For example, we have to know what is meant by presentation in financial reporting, and then how financial statements are presented, what is disclosure of informations, a kind of disclosure in accounting, also the reason why any business need to disclose very important information. And then we also talk about how information should be disclosed. Then we talk about some trend in disclosure practice like social and environments disclosure, and then sustainability reporting. Also the last one, the most current model of reporting, what we call as integrated reporting. Okay, to begin with, you might discuss this simple cases faced by an investor. Just assume Taylor Swift is a green investor who is aware of the environmental issues in doing business. So if she interested in the financial problem company, the question is what kind of information she need, and then from which part of financial statement she gathered the informations. Also, when he concerned with how the company handle employee issues, the question is how should he collect the information, from which part of financial statement she might collect the information. And then another issues might be an issue about the capital flow. If there are significant information about capital flow, so the question is from which part of financial statement she might collect the informations. Also, when we talk about the ability of a company to pay dividend, to pay interest, and so on. Also, we need how we should get the data, the information from the financial statement. And lastly, when we talk about environmental issues, how company deal with the environmental issues. So the question is, how should an investor need these informations, and then which part of financial statement or maybe some other source of information she needs to collect the information. So this is just a simple discussion that you need to aware of, and then I think it's better for you to take some clue what kind of information you need to answer this question, and then which part of financial statement you need to answer this question. This is a discussion, so you might discuss this issue later with your friend and so on. All right, the first section of our today topic is presentation of financial statement. So the question is, what is the presentation of financial statement? When we talk about the presentation of financial statement, so we actually need to understand what is the objective of financial reporting. In general, the objective of financial reporting is to provide the user with the information about the financial position, financial performance, and also financial flow of an entity that is perceived useful in making any economic decisions. So to achieve this objective, I think it is important to know how the information should be presented. That is the reason why we need to talk about the presentation of financial statement. As the fact that the main purpose of financial reporting is to provide the user with some important information, relevant information, faithful information, then the question is how we have to meet the objective of financial statement. So to meet the objective, at least we have to able to provide the users about any information dealing with asset, liabilities, equity, and then cash flow. Also, any information concerned with contribution by and distribution to the owners, and then income and expense, including gains and losses. So how we able to read to understand about the information provided by the financial statement? Then we have to need understand how we should present the informations, and then how we should disclose the informations. So that is why we need to talk about the first one is presentation, and the second one is about disclosure. When we talk about what is presentation of financial statement, actually we talk about the provision of informations in accordance with the format of complete set of financial statement. It means that presentation is concerned with how we should provide the information in certain formats that represents a complete set of financial statement. So if we talk about complete set of financial statement, we talk about the statement of financial position at the end of the periods. And then the second one, we talk about a statement of profit or losses and other comprehensive income for the period. And then we also need to talk about the statement of changes in equity for the period. The fourth one, an information concerning with the statement of cash flow for the period. And the last one, we need to provide information in terms of notes to the financial statement. So this is a summary of accounting policies and other explanatory notes to support any item we provide on the four financial statement element. Okay, then when we talk about statement of financial position, in general, in this statement, we try to set a format how we should present the information about asset, how the asset are financed, talking about the liability and the equity we have from the creditor and the owners. Then, when we talk about the format, if we refer to accounting regulation, for example, if we deal with the International Accounting Standard number 1, actually this standard does not prescribe the format of the statement of financial position. It means that any country that adopt International Accounting Standard may set their formats according their environments. That's why when we talk about Indonesian Accounting Standard, what we call as PSEK, Penjelasan Akuntansi Keuangan, then we can see the format of presentation looks different from the IFRS formats. But in general, what is regulated by the International Standard is that the asset should be classified according to current asset and non-current assets. And then liabilities and equity also should be classified into current liabilities, non-current liabilities, and equity. But the order, whether we want to start the presentation from current asset followed by non-current asset or vice versa, we start from non-current asset then followed by current assets, it's up to the country who adopt the standard. So there is no absolute format of presentations. The important thing is how we should classify these two different things in a different group. That means that current asset should be separated from non-current asset, and then current liabilities should be separated from non-current liabilities and also separated from equity. Whether the order of presentation starting from current liabilities or maybe starting from equity is not the main deal. So we need just to classify in accordance with the characteristic of each asset and the characteristic of liabilities and also equity. So there is no exactly the same format in presentations. Everything depends on the country that adopt the international accounting standard. So we can start presentation from current asset, or maybe we can start presentation from non-current asset and vice versa. Okay, based on the rules set by the international accounting standard, then we might see the differences here. For example, when we talk about the format of presentation proposed by PES AK or in Indonesia environments, we start presenting asset from current asset, then followed by non-current asset. And then in the side of liabilities and equity, we start presenting current liabilities and then followed by non-current liabilities, and then followed by equity. In this equity, we also divided the equity into two groups. The first one is non-controlling interest, and then the second one is equity attributed to the owners of the parents. Meanwhile, when we talk about the format of presentation proposed by International Accounting Standard, we can see here that in the group of asset, IAS, International Accounting Standard, start presenting asset from non-current asset, then followed by current asset. In the opposite column, we can see equity and liabilities presented differently from Indonesia format, because in International Accounting Standard, they start presenting the information about equity classified into two groups, non-controlling interest and equity attributed to the owners of the parents, and then followed by liabilities, which is classified into two different liabilities, that is current liabilities followed by non-current liabilities. The second statement we have in organization is a statement of profit or loss and other comprehensive income. So this statement actually describe about the entity financial performance in a way that is useful to a wide range of users. So this statement consists of two main sections. The first one is profit or loss for that periods, or we call as earning. And then the second part is other comprehensive income recognized in the period. And then the combination of these two components result in total comprehensive income for the period. So talking about statement of profit and loss or loss and other comprehensive income, this statement should include all items of income and expense which is recognized in the period, except the standard or any interpretation require other treatment or otherwise. So as long as there is no specific standard, so all item of income and expense in the recognized in the period should be included in the statement of profit and or loss. And then beside income and expense that is presented in statement of profit, the statement also includes some component that might be excluded from profit or loss, but included in the other comprehensive income. So as I mentioned before, this statement consists of two parts. The first one is profit or loss, and then the second one is other comprehensive income. How we differentiate these two parts, we can see in the next slide. So this slide describes the component of other comprehensive income, which is excluded from profit or loss, but included in the other comprehensive income. So what is the item that should be included in this comprehensive income? You can see here the first one is the changes in revaluation surplus as regulated in IAS 16 and IAS 38. This is talking about the way that the company revaluate their asset, and then in revaluation we might find that the current value is higher than the old value. Then we have to recognize the surplus. This is what we call as changes in revaluation. And then we might also include actuarial gains and losses on the defined benefit plans as recognized in accordance with IAS 19. We also have gain and losses resulting from translating the financial statement of foreign operations, when we know that maybe the company have the foreign currency, and then we have to translate it into rupiah, for example. So there will be gain and losses. Then the gain and losses should be included as part of other comprehensive income. We also might got gain and losses on remeasuring available for sale financial asset as regulated in IAS 39, and then we also included any item in terms of effective portion of gains and losses on hedging instruments in a cash flow hedge as regulated in IAS 39. The third element of financial statement is a statement of cash flow, and then this statement of cash flow is regulated in the International Accounting Standard 7, talking about statement of cash flow. And then we know that the statements provide us with the information how any entity cash or cash equivalent change during the periods. So as we discussed in the intermediate accounting, technically, we classify cash flow into three activities. The first one is operating activities, which concern with the main revenue producing activities such as cash received from customer and cash paid to the suppliers and employees. And then the second one, we have investing activities that describe the information about the acquisition and disposal of long-term asset and other investment. And then the last one, we have financing activities. So these sections provide user with information about activities that change the equity capital and the borrowing structure of the entity. Next one, the fourth element of financial statement is a statement of changes in equity. So as stated by International Standard number 1, the standard require a statement of changes in equity as a separate component of the financial statement. What does it mean? It means that the total comprehensive income for the periods we should classify into separate amount. So this amount should be separately classified to show which amount should be attributable to the owners of the parents and which part of amount should be attributable to the non-controlling interest. And then we also need to make some reconciliations about the carrying amount, especially at the beginning and the end of the period for each component of the equity. And then we need to disclose this item, the following items separately. For example, when we talk about profit and losses, and then each item of the other comprehensive income, and also transaction with owners. So these three items should be disclosed separately to show which item concerned with profit or loss, and then which item should deal with under comprehensive income, and the last one, which item should be concerned with transaction with owners. The next aspect of statement of changes in equity is that we need to include the effect of retrospective applications when applicable for each component, especially when there is a changes in accounting policy and so on. So we can see in this picture here, we assume that the changes of accounting policy or accounting methods have been made on the 2nd January 2020. For example, when the changes of accounting policy is dealing with new accounting standard in the blue box here, when there is changes in the new accounting standard implementation as required by a mandatory changes, for example, the adoption of IFRS, then we have to use retrospective approach. It means that we have to restate the previous year's financial statement. The second example, as we can see on the blue box here, is that the company might implement new accounting policy. For example, from a FIFO to the average method. This is the similar condition if the company adopt new accounting policy from FIFO to average, then the changes should have retrospective effect. It means that the previous financial statement should be restated. And then if we find any material error, the similar treatment should be taken. It means that we adopt retrospective approach by restating the previous year financial statement. Meanwhile, when the changes is concerned with accounting estimate, in this case, I write in the red color, red box here, then the changes have the prospective effect. It means any changes in accounting estimates only influence the financial statement in the year that we make changes and then the following years. So there is no need to restate the financial statement because these changes in accounting estimate only influence the current condition in the year in which we make some changes, and then the effect will also influence the next period. So these changes deal with prospective changes or prospective approach. Okay, this picture show how any item of or any transaction concerning with equity that might influence the equity should be included in the statement of changes in equity. So we have CTD here, current transaction differences, and then we also have AFS as available for sale item. We got CFH here, cash flow hedging, and then the last one we have the column that provide us with information about any item attributable to the non-controlling interest. So at the beginning, we got some changes in accounting policy, and then we make some restatement of the previous item, and then we got changes in equity in the year. For example, share issues, the dividend, and total comprehensive income. Then we total everything of the item and then put it in this statement of changes in equity. The last three one as circled in the red color here, especially any item that is disclosed in the statement of profit or loss and other comprehensive income. Okay, the last section of financial statement is notes to the financial statements. So if we refer to International Auditing Standard number 1, normally These notes should present the following informations in order. The first one is a statement of compliance with IFRS. So if the company comply with international financial reporting standard, so the company should declare by writing the statement that they comply with the international reporting standard. And the second one, we also should put information about the summary of accounting, like measurement basis, how any item of financial statement are measured, and then we also provide information about other accounting policy used in uh, the year, so we can clearly see, for example, how inventory is valued, whether using a FIFO or other method, and then how depreciation is calculated and so on. And then we also provide information about supporting item, especially those items that presented in statement of financial position, and then statement of profit or loss and other comprehensive income, and then statement of changes in equity, and statement of cash flow in the order. Lastly, we also discuss other information like contingent liability as regulated in Accounting International Standard number 37, and we also may disclose unrecognized contractual commitment. And then we also need to disclose non-financial disclosure such as entity financial risk management objective and policy as regulated in the International Financial Reporting Standard number 7. Again, in the previous section, we already talked about presentation of financial statement. Now we talk about disclosure. Okay, when we talk about disclosure, we need to clearly define what is meant by disclosure. Based on Cambridge Dictionary, disclosure is defined as the act of making something known or the fact that is made known. And the second definition of disclosure in this Cambridge Dictionary is the act of giving such information to the public. But in accounting, disclosure can be defined as the act of releasing all relevant information on the company that might influence an investment decisions, making public both positive and negative news, data and other detail about operations and the impact of its operation in timely fashions. In other words, disclosures deal with how we should release all relevant information to the user that enable them to make any decision, especially in investment and credit decision. So based on the definition, we might take some key point here that disclosure is deal with the act of releasing all relevant information that might influence the investment decisions. So this information is concerned with company financial condition, maybe operating result and management compensation and other information. And then disclosure should be concerned with releasing information to the public. For example, when we refer public, we talk about how we release information in the stock exchange. And then when we release the information, we should consider the regulation of providing information. For example, regulation as released by the Capital Market Authority. So it is impossible to just disclose whatever the information we need, but we have to consider what is regulated in certain capital markets on the way the company should disclose the information. Disclosure may be classified into two main groups. The first one is adequate disclosure and the second one is full disclosure. So the adequate disclosure is how all essential information should be included in the financial statement. So we focus the informations only on the essential ones, the essential information. So we provide the essential information to the investor or creditor that rely on the informations. So for example, how financial statement, footnotes, supplements, schedule provides a comprehensive and clear description about the company financial conditions that is perceived as essential information for the users. This is what we call as adequate disclosure. Okay, beside adequate and full disclosure, we also have what we call as fair disclosure. And then this type of disclosure is concerned with how to release any material non-public information to the public that it has disclosed to certain individuals outside the company. So the purpose of this fair disclosure is to ensure that the public might obtain relevant information that also been shared with the selected individual. So this is what is called as a fair disclosure. And then we have the full disclosure. So different from adequate and fair disclosure, full disclosure did deal with how we should disclose all relevant and necessary information that should be available for the public. So this might involve mandatory disclosure and also voluntary disclosure. We will talk later about mandatory and voluntary, but in general, the company, when we talk about full disclosure, they might take disclosure policy based on mandatory and voluntary disclosure. So even though in full disclosure we need to disclose all relevant and necessary information, but we have to careful in releasing the information, because the full disclosure principles doesn't mean that we need to release all available information to the public. So it is impossible to release everything we know about the entity and then release the information to the public. So we have to focus on information that we perceive have a material impact on the company financial result or have a material impact on the financial positions. So what does it mean here is that full disclosure does not require us or our manager to disclose everything, but we need to consider which one of information that we believe have a material impact on the company financial result or position. All right, then as the fact that we have three kind of disclosure, we have full disclosure, fair disclosure, and then adequate disclosure. But in the content practice, we prefer to use full disclosure. So why we need to adopt full disclosure? The main reason why we adopt full disclosure is that full disclosures might foster transparency and limit the opportunity for potentially fraudulent activities. So when we disclose important information that have a material impact, so we believe that the information will be more transparent, and then it is possible to prevent a practice that might involve fraudulent activities, that might involve manipulations. And then full disclosure also can be used in a contractual law, because in the law it is stated that the parties in business transaction must disclose to each other all material information that is related to the execution of the transactions. So if we already disclose any important information that have material impact, then we have obey the law, and then the possibility of legal sanction can be avoided. So this is the reason why we need a full disclosure in accounting. And now we see here some common item of full disclosure. For example, we need to disclose information that deal with audited financial statement, then accounting policy and changes in the accounting policy. The third one is non-monetary transactions, material losses, asset retirement obligation, detail and the reason of a goodwill impairment, and then the existing litigations involving a legal sanction and so on. Also, we might disclose information concerning with forward-looking statement to anticipate the future direction of the company and the event that can influence the entity financial performance. So this some common item that deal with full disclosure. And the next one in this slide, we can see the full disclosure and financial reporting. We adopt full disclosure principle to increase information by obeying any reporting requirement, and then we might have provide some information that deal with differential disclosure, and then note to financial statement consisting information about accounting policy and common notes. We also deal with some disclosure issues like special transaction event, special transaction, special event, and then maybe information about post balance sheet event, or what we call as subsequent event, and then might be concerned with information of diversified companies and also interim report. And then we also need to disclose information dealing with auditor and management report. In this case, we have to discuss about auditor report and then management report. And then we have deal with some current reporting issues like reporting on forecast and projection, internet reporting, financial reporting, fraudulent financial reporting, any other criteria for accounting and reporting choices. So this is a wide range of information that categorizes full disclosure in financial reporting. Meanwhile, when we talk about voluntary disclosure, we talk about the provision of information beyond requirement. So we provide more information because we provide information beyond the requirement as stated by accounting standard or capital market rules, where the information is believed to be relevant to the decision making. So we goes beyond the mandatory one. So if we believe that any information that is not regulated by any rule, and we believe that this information is important and have a material impact on the financial position, then we might disclose the information voluntarily. That's why in terms of voluntary disclosure, what kind of information should be disclosed in terms of voluntary disclosure is simple. As long as the disclosure of information provide us with more benefit than cost of disclosure, then we should disclose the information. So cost benefit considerations is the key aspect that we have to consider when we want to disclose any information voluntarily. Okay guys, beside adequate, fair and full disclosure, in accounting we also have a term what we call as mandatory and voluntary disclosure. So we need to know about these two the difference between these two. So mandatory disclosure is concerned with the provision of information based on the legal requirement. So we only disclose what is required by legal rule, such as accounting standard, and then maybe regulation released by the capital market authority. So in terms of mandatory disclosure in financial statement, we might need to consider about international standard. Number one, presentation financial statement, and in the Indonesia environments, we might also need to pay attention on the revised PAPAPAM rule about the presentation and disclosure requirement for financial statement prepared by publicly listed entity Indonesia. So mandatory is concerned with any legal requirement. So we only disclose based what legal law required in the disclosure. Then we can see here some voluntary disclosure as mentioned by Financial Administrator Board, like business data, analysis of business data, forward-looking information like a forecast, sales forecast breakdown, plans for expansion. Then we also may disclose information about management and shareholder, and then company background like product description and long-term objective. And then we also need to disclose about information about intangible asset, also some other kind of disclosure like intellectual capital disclosure, maybe CSR disclosure, carbon content disclosure, and other disclosure. Okay, as I mentioned before, that voluntary disclosure deal with benefit and cost consideration. So this is some benefit and cost of voluntary disclosure. In terms of benefit, voluntary disclosure may increase investor confidence on the quality of company equity offering. And then second one, obtain capital cheaply from the capital markets. And the third one is get better deal from the supplier. And then from the cost, we can see cost of voluntary disclosure might involve information collection, information processing, and dissemination costs. And then the second one, the cost of voluntary disclosure is deal with competitive disadvantage costs, also litigation costs, and political costs. You might search any term here like litigation costs, political costs, and competitive advantage costs dealing with voluntary individually because we have limited time to discuss everything here. Okay, guys. Other aspect concerning with presentation disclosure is what we call of interim report. So in business, we might find what we call as interim report. So interim report is actually a financial statement reported for a period less than 1 year. So interim report might be a report that is presented semi-annually, quarterly, or even monthly basis. The main purpose of interim report is to provide us with the better and transparent communication, to provide good relationship with investor by providing an update information between two annual report. So interim report is any report less than 1 year, and we present this report between two annual report. So this year's and last year's. So this is a simple example how we need interim report. For example, when we look at this table, we may see that the operating profit of this business has risen on year-on-year basis, but there has been a drop in the quarterly number. We can see here that in quarter 4, that the performance was not good, even though we can see that there was a good 12% increase in the profit on the annual basis. So this information provides us with a condition that actually this business is concerned with seasonality of IT business in the quarter 4 during October and December. And this condition should guide the management in planning for their long-term strategic initiative. Then from the major objective of interim report, we can see here that interim report may provide estimation about annual earning based on the interim financials, and then make cash flow projection, identify a turning point in terms of financial statement status, and then evaluate management performance to formulate internal control procedure, and also to supplement the annual report. So this is six major objective of creating interim report in a business. So the next question is, what is the content of interim report? The content of interim report usually consists of the following item. The first one is the condensed position of financial statement. Second one is the condensed statement of finance of the cash flow, and then condensed profit and loss statement, and then followed by explanatory notes relevant to the data reported. So we may use the same accounting policy as annual reporting, the item affecting a section of financial statement like asset, liabilities, equity, and income, and then any new issuance of stock, buyback, repayment, or restructuring of debt, and then dividend for equity share, also impact of the new acquisition for long-term investment, and any investor or regulatory complaint. So this is some information that need to be disclosed in the notes of interim report. Now we talk about disclosure trend. So we have some disclosure trend during 10 year, and then we will talk later in general. So this picture describes the development of or the evolution of corporate reporting. We start from the era of Luca Pacioli, 1494, and then in around 1850s we have a concept of financial reporting, and then in 1990s we have social accounting and reporting. Then we have environmental reporting during the same era, 1990s, and then in around 2008 we have before we have the new one in the reporting, we have sustainability reporting in 2000, and then the last the most current reporting we have now is integrated reporting. So what is social and environmental disclosure? Social and environmental disclosures deal with provision of information about entity and its impact on the social and environmental issues. So if we deal with this social and environmental disclosure, we focus our attention on the interest of stakeholder, not stockholder. Stockholder is only deal with shareholder, but when we talk about stakeholder, we talk about shareholder, we talk about creditor, we talk about employees, we talk about environment, we talk about maybe supplier, consumers, community, and so on. So we deal with the wide range of parties when we talk about stakeholder. But when we talk about stockholder, we only concern with the owners, the shareholder. So this is how we differentiate stockholder with the stakeholder. So why we need to disclose this information? I mean, social and environmental information. In general, the main reason, if we refer to some textbook, even though we got some reason, but in general, the reason why we should disclose social and environmental activities or issues is to avoid social conflict with the stakeholders. And then the concept of social and environmental disclosures develop further. Now we know we have sustainability reporting that deal with how we respond, how business respond with the sustainability issues like global warming, climate change, storm, energy stress and emission, disease, and then water stress, also property. So there is changes in the landscape of business paradigm. So okay, talking about sustainable business, as I mentioned before, there is paradigm shift from the 1P paradigm or profit paradigm to 3P's principle, what we call as profit, planet, and people. So business is not only concerned with profit, but we also have to concern with planet, the environments, and the people, the community, the business community, the employee, and so on. So this is the core value of sustainable business. We have to run business that is economically viable, environmentally responsible, and socially accountable. And then this shift usually embedded in sustainability management, which produce sustainability reporting. So sustainability reporting is reporting on the economic, environmental, and social policy impact and performance of an organization or an entity and its product in the context of sustainable development. So sometimes we also call this sustainability reporting as triple bottom line reporting. So sustainable governance actually demands business become more open, more accountable for economics, environmental, and social consequences arising from corporate decision, corporate action that they disclose this impact in the external report, which is called as sustainability report. In term of institution, we also have a guidance how we should report sustainability issues in certain reporting. So this guideline or the standard issued by Global Reporting Initiative since 2000, and then maybe you might check the latest version, the Global Reporting Standard. If I'm not mistaken, the last standard is released in 2021. So just grab this website, check the latest standard of sustainability report. Okay, this is the first section of sustainability report. Any company, when he take this sustainability report, should provide information about economic performance, dealing with economic value generated and distributed, and then financial implication of the climate change, the infrastructure development, and the economic impact on the local market. This is from economic performance perspective. From environmental performance perspective, the entity should provide us with information dealing with material consumed, energy consumed, influence, emission and waste, and then water withdrawal, biodiversity issues, the impact of the products, and how the company should comply with the law. This is some information that need to be disclosed in terms of environmental performance. The last one of sustainability reporting is social performance information that deal with information of employment and then labor relations, health and safety, training and education, diversity and equal opportunity, including any issues concerning with human rights. So this is the perspective of social performance that should be included in sustainability report. Okay, the other trend of disclosure is carbon emission disclosure. So different from social and environmental disclosure. This disclosure is more specific, and then carbon emission disclosure, sometimes called as greenhouse gas emission disclosure. So in this disclosure, we try to provide information about how company reduce the gas emission resulting from their activities, including any gas dealing with water vapor, carbon dioxide, and then methane, nitrous oxide, ozone, chlorofluorocarbon, hydrofluorocarbons, and so on. So we try to disclose any information we deal with these gas emissions produced by the company during their activities. And then the last trend in financial reporting is integrated reporting. So integrated reporting is actually a process of integrated thinking that result in any periodic integrated report by an organization about value creation over time, and then related communication regarding aspect of value creation. So actually integrated reportings uh, deal with a concise communication about how we disclose information about organization strategy, the governance, the performance and prospect, and also the context of external environments that leads to the creation of value in the short, medium, and long term. So we think about different term, not only talk about the short term, but we think about short, medium, and long term. Then if we refer to this picture, we can see here that actually in integrated reporting is consistent with the development in financial and other reporting, but an integrated report also differ from other report and communication in a number of ways. In particular, integrated reporting focus on the ability of an organization to create value, as I mentioned before, in short, medium, and long term. And in so doing, integrated reporting is a concise communication about how organization strategy, governance, performance, prospect in the context of its external environments lead to the creation of value for the short, medium, and long term. And then integrated reporting has a combined emphasis on conciseness, strategic focus, and then future orientations, the connectivity of the information and the capital and their interdependence. And then lastly, integrated reportings emphasize in the importance of integrated thinking within the organization. So each section are integrated each other, dealing with strategy, governance, performance, and prospect, and then including the external environments. Those based on the concept of integrated reporting, then we can see here that integrated reporting may provide information dealing with financial issues, economic issues, social aspect, environmental aspect, government, as well as intangible issues of the companies. Also in integrated reporting, we have different type of capital. So the capital can be defined as stock of value that is increase, decrease, or transform through the activities and on the output of the entity. So this includes financial capital, concerning with the funds used for the production, good and service from finance. And then we have the second capital, that is manufactured capital, talking about physical object available for use in the supply or production of goods services. And then we also have intellectual capital, talking about organization knowledge based of intangible such as patent and who license, protocol, and also copyrights. We also have human capital here in the reporting, dealing with people competency, and then skills, also their ability to innovate and lead based on the entity strategy. We also have social and relationship capital, talking about the institution and the relationship within and between communities, groups of stakeholders, and other network, and the ability to share information to enhance individual and the collective well-being. And lastly, we also have natural capital, concerned with all renewable and non-renewable environmental resources and process that provide good or services that support the past, current, or the future prosperity of the organization. So this is 6 types of capital that is deal with integrated report. If we look at this slide here, we can see that integrated reportings as an aim or objective to improve the quality of information available to providers of financial capital to enable a more efficient and productive allocation of capital. Secondly, integrated reporting also aims to promote a more cohesive and efficient approach to corporate reporting that draws on different reporting strengths and communicate the full range of factors that materially affect the ability of organization to create value over time. And then integrated reporting also play important role in enhancing the accountability and stewardship for the broad-based capital, such as financial capital, manufacturing capital, intellectual capital, human capital, social and relationship capital, and as well as natural capital, and in promoting understanding of their interdependencies. And then lastly, integrated reporting aims to support integrated thinking, decision making, and action that focus on the creation of value for the short, medium, and long term. In practice, actually, the important point of integrated reporting has been established by certain rule, especially as proposed by the International Integrated Reporting Committee, which is established in 2nd August 2010. And then in some countries, this integrated reporting has been implemented well. For example, listed companies in South Africa have to present integrated report for financial year and starting on the or after 1st March 2010. And then in the Indonesia environment, some companies also have a practice integrated reporting, such as PT United Tractor. This company start implementing integrated reporting since 2009, and we also see here PT Timah TBK that start implementing financial integrated reporting since 2010. Okay, that's all guys. To conclude, in accounting practice, we need to, especially in terms of accounting theory, we need to understand about what is meant by presentation of financial statement, what is disclosure, and how we differentiate adequate, fair, and full disclosure, as well as how we differentiate mandatory and voluntary disclosure. And then we need to understand about the trend in disclosure, especially those concerned with social and environmental issues or sustainability or maybe carbon emission. And lastly, the most recent type of financial reporting is integrated reporting that provide us with more concise and cohesive reporting that include financial, economic, social, environmental, government, and intangible information. And the objective, the ultimate objective of financial or integrated reporting is to create value in short, medium, and long term. So that's all our topic today. And then after learning about this topic, then you might go to the team. We got a link to finish the post test to identify your understanding about today's topics. That's all guys. Wish you enjoy your study. See you next time. Bye bye.